Imagine this. It's a crisp morning in 2026. You check your investment app, expecting steady gains from your AI-managed portfolio. But in a blink, trillions evaporate from global markets, not from a war, not from a recession, but from lines of code that outsmarted themselves. What if the very technology promising to make us all richer could trigger the biggest financial meltdown since 2008? Today, we read diving deep into how AI is reshaping investment strategies in 2026. But here's the mystery that will keep you watching. Is AI the savior of your retirement or the architect of its downfall? We'll unravel this step by step, revealing causes, effects, and shocking twists you never saw coming. Let's set the stage. To understand AI's grip on investing today, we must go way back to when finance first flirted with artificial intelligence, the early 1980s. As computers began infiltrating banks, a company called Apex introduced Plan Power, an expert system designed to mimic human financial planners. It wasn't the flashy AI we know now. It was rule-based, following if-then logic to spit out advice on taxes and estates. But this sparked a revolution. Why? Because human advisors were slow, biased, and expensive. AI promised precision without the coffee breaks. Fast forward to the 1990s, and key figures like Alan Turing's intellectual heirs, computer scientists pushing machine learning into the scene. Banks experimented with neural networks for credit scoring, predicting defaults better than any actuary. Tease this. These early systems laid the groundwork for something explosive, but they also planted seeds of chaos that would erupt decades later. Meanwhile, financial systems evolved from manual trades to electronic exchanges, setting up a domino effect where speed became king. What if I told you this pursuit of efficiency would one day cause markets to crash in milliseconds? Hold that thought, we'll get there. Origins. The quiet birth of AI in finance. Now let's tell the story chronologically, tracing cause and effect, like a detective piecing together a crime scene. It all originates in those 1980s expert systems. The cause. Exploding data volumes from globalized markets overwhelmed human analysts. The effect, firms turned to AI for pattern recognition, starting with simple algorithms and algorithmic trading. By the late 1990s, quants, those math whizzes on Wall Street, were coding bots to execute trades based on predefined rules. This wasn't sci-fi. It was practical. For instance, in 1998, long-term capital management's AI-driven hedge fund nearly collapsed the economy, showing early cracks. But the allure was irresistible. AI could process terabytes of data, spotting opportunities humans missed. The rise began in earnest in the 2000s, with high-frequency trading (HFT). Cause. Advances in computing power and broadband internet allowed algorithms to trade thousands of times per second. Effect. By 2010, algorithmic trading handled over 75% of global trade volume. Firms like Renaissance Technologies, led by math genius Jim Simons, amassed billions using machine learning to predict market moves. Robo-advisors emerged like Betterment in 2010, automating portfolios for everyday investors. The twist? This rise democratized investing. Anyone with a smartphone could access AI-powered strategies. But as adoption soared, so did interconnectedness. Markets became a web of algorithms talking to algorithms, amplifying small signals into tsunamis. You're probably wondering, when does this house of cards tumble? Patience, the breaking point is coming. The rise from tools to titans. By the mid-2010s, AI's rise accelerated with deep learning. Cause, breakthroughs in neural networks fueled by big data from social media and IoT devices. Effect, investment firms integrated AI for predictive analytics, sentiment analysis from news and tweets, and even quantum-inspired models for complex simulations. In 2018, BlackRock launched its AI engine, Aladdin, managing trillions in assets. Success stories piled up. AI strategies outperformed humans by 20 to 30% in volatile markets. But here's where curiosity piques. What happens when these super smart systems sync up too perfectly? Enter the breaking point, the 2010 flash crash. On May 6, 2010, the Dow Jones plunged 9% in minutes, wiping out $1 trillion before rebounding. Cause a single large sell order triggered a chain reaction among HFT algorithms, which amplified the drop through rapid automated responses. Effect: panic, investigations, and the realization that AI could create flash crashes without human intervention. Fast forward to 2022's crypto meltdowns, where AI bots exacerbated volatility in assets like Bitcoin. The mystery deepens. If AI caused these, why didn't we stop it? Because the benefits outweighed the risks until they didn't. The fallout was swift but uneven, as regulators scrambled post-2010, implementing circuit breakers to halt trading during anomalies. Effectively, markets stabilized temporarily, but AI evolved faster than rules. By 2024, AI-driven trading contributed to higher volatility in stressed times. As noted by the IMF, investors lost billions in mini-crashes, eroding trust. Systemic risks emerged. Third-party AI dependencies meant one vendor's glitch could cascade globally. Black box issues where even creators couldn't explain decisions led to AI washing, firms hyping unproven tech. The human cost? Losses for analysts widened inequality as elite firms dominated. Attempts to fix it failed spectacularly, because patchwork regulations like the EU's AI Act in 2024 aimed to curb risks, but enforcement lagged. By 2025, 90% of finance teams deployed AI anyway, ignoring warnings. Failed fixes included bias audits that missed subtle flaws, inexplainable AI mandates that slowed innovation without solving opacity. Why did they fail? Because AI's cause and effect chains were too complex to fix. One link and another breaks. This sets up our modern twist. History is repeating, but on steroids. Now, connect this to 2026. Shocking data. Global AI investment in finance hit $45 billion in 2024. It's projected to double by 2026. U.S. private AI funding reached $109 billion in 2024, dwarfing competitors. Patterns repeat, just as 2000's HFT led to crashes. Today's agentic AI systems that act autonomously could trigger flash crashes 2.0. By 2026, 75% of companies may invest in agentic AI, fueling GDP but risking instability. Deloitte predicts 75% adoption, with AI embedded in enterprise strategies at 58% already. Modern parallels, crowded trades where AI herds into the same stocks, amplifying bubbles like the 2023 AI stock frenzy. Shocking, 70% of finance pros see faster work with AI, but 1 in 5 report ROI over 20%, masking underlying volatility. The mystery resolves. AI reshapes strategies by personalizing portfolios, predicting trends with 95% accuracy in some cases, but it echoes past over-reliance on tech. Modern parallels. History repeats. So what have we learned? Here are 3 clear takeaways to arm you for 2026. First, embrace hybrid strategies. AI excels at data crunching, but combine it with human oversight to avoid black box pitfalls. Because pure AI leads to echo chambers. Diversified decisions yield steadier returns. Second, prioritize ethics and transparency. Demand explainable AI from providers, don't invest blindly. Shocking pattern. Failed fixes in the past stemmed from opacity. Break the cycle by choosing regulated tools. Third, educate yourself on risks. Understand flash crashes aren't relics. With AI handling 85% of trades by 2025, volatility is inevitable. Monitor your portfolio actively. A final warning. As AI integrates quantum computing by 2026, could we see crashes not in minutes but microseconds? Or will regulations finally catch up? It's an open-ended question. Your investments hang in the balance. If this sparked your curiosity, hit that subscribe button, like the video, and drop a comment. How is AI changing your investing? Turn on notifications for more deep dives into the future of finance. Thanks for watching. Stay smart, stay invested.